Hello everyone and welcome back to the channel. This is the place where I break down the principles of value investing to help you invest in quality companies for the long term. For those who are new to the channel, my name is Anand. I'm a software engineer turned quality value investor managing my own portfolio for the last 7 years. Growing up in India, protecting capital was always the priority. As I committed myself to a journey of lifelong learning, studying giants like Buffett, Munger and Phil Fisher, I realized I could use my technology background to make value investing simpler. And that is why I built LVI, or Let's Value Invest, a platform built around these very principles of buying high quality, wide moat businesses. And I also created this channel to share the same learning with you. The second quarter 13F filings for 2026 are officially out. If you are not familiar with them, 13F filings are quarterly reports required by the SEC for all institutional investment managers managing at least $100 million in assets. These managers are required to disclose their long equity holdings within 45 days of the end of the quarter. Through these filings, we get a rare, transparent look at exactly where the world's best investors have been putting their money lately. For me, tracking these filings is incredibly valuable. It acts as a second filter, a second screener. It helps me generate new stock ideas, and more importantly, it helps me build conviction in the businesses I already own. But looking at these filings in most places is painful. Previously, I used sites like Dataroma, and they do the job, but they track far too many investors, which basically dilutes the focus. Plus, I really dislike those ad-driven platforms. I wanted something clean, focused, and easy to track. So I built a super investors tracking feature directly inside the Let's Value Invest platform. Currently, we are tracking 49 carefully selected super investors. These are managers who strictly follow the quality value investing principles that LVI is built around. They basically focus on buying outstanding businesses, running highly concentrated portfolios, often allocating over 50% of their capital to their top 5 to 10 holdings. And they do not trade frequently. Over time, I will add more managers who fit this framework and possibly remove those who don't. If there is a specific super investor you want me to track on LVI, let me know in the comments below. Today we are looking at the quarter 2 13F filings for the top 3 super investors on the LVI platform. And to select these 3, I used a strict set of criteria. First, they must have an LVI portfolio score above 3.5 out of 5. Second, they must manage over $1 billion in assets. And third, they must practice extreme concentration, meaning they hold fewer than 10 stocks in their entire portfolio. By studying these 3, we get the absolute highest conviction ideas from the best managers in the world. And if you watch until the end, you will see 3 fascinating quarter 2 strategies. We will look at how a forced structural decision led one of the manager to systematically trim his best holdings, how another completely liquidated 5 positions to double down on his top conviction anchors, and how our third manager executed a major capital rotation to buy the dip in tech and payments. Our first profile today is Dev Kantesaria, the founder and portfolio manager of Valley Forge Capital Management. Dev has one of the most outstanding track records in the industry. He started his fund in 2007 with just $300,000, and today he manages over $4 billion. According to online sources and my research with Gemini, from 2007 through 2024, he has compounded capital and at an estimated 15% compound annual growth rate, significantly beating the S&P 500's 10% return over the same period. Dev's core philosophy centers on what he calls concentrated conviction. He strongly rejects broad diversification. Instead, he focuses on high conviction quality compounding. This is the Warren Buffett, Charlie Munger, and Phil Fisher style of owning wide moat businesses for decades. And his filter is incredibly strict. He only buys businesses that meet 3 rules. First, entrenched monopolies, essential toll booth services like credit ratings or payment rails. Second, inelastic pricing power, the ability to raise prices without losing customers. And third, capital light predictability, low capital expenditure requirements and clear 10-year visibility, where management uses excess cash for share buybacks rather than risky acquisitions. Because of this strict filter, Dev runs a hyper-concentrated portfolio of just 6 to 10 stocks. Looking at his card on LVI, his total portfolio value stands just above $3 billion. As we enter his portfolio, look at these metrics. He holds only 7 stocks. That is extreme concentration. His top 5 concentration is a massive 93%. His LVI portfolio score is a very strong 3.74 out of 5, which rates as good on our platform. Now let's go over to the Key Insights tab to see the fundamental strength of his holdings. LVI calculates the weighted average of fundamental metrics across the entire portfolio. Look at his Moats score. It is a very good 4.36 out of 5. This tells us he is buying businesses with massive, durable, competitive advantages. His business quality score is a good 3.65 out of 5. Dev is not buying cheap average companies. He is buying elite compounders. Now let's look at what he did in the second quarter of 2026. Dev is a classic do-nothing kind of investor who normally hates to sell. But this quarter, he had a quarterly activity rate of 15.23%, making 4 reduces and no buys. Let's look at what he actually trimmed. He reduced his largest holding, Fair Isaac or FICO, by 12.63%. He reduced S&P Global or SPGI by over 13%. He reduced Mastercard by over 28% and he reduced Visa by 22%. Let us open the transaction history model for S&P Global to see how rare this is. If you look at the historical trend chart on the screen, Dev has done almost nothing but buy or hold SPGI since quarter 4 of 2021. So why did he systematically trim 4 of his top high conviction positions at the same time? Since he has publicly stated that he prefers to be fully invested at all times and he did not buy anything new with the proceeds, this points to one primary catalyst: investor redemptions. When clients ask for their cash back, a highly concentrated manager is forced to sell down shares across all of his holdings to raise cash. So this trim across FICO, SPGI, Mastercard and Visa is likely a result of fund flows, not because he lost conviction in these businesses. For us as individual investor, this is a great lesson. Do not panic sell just because a super investor trimmed a stock. Their reasons for selling are often structural and it may not be fundamental. Let's move on to our next super investor. And this is Li Lu, the founder of Himalaya Capital Management. Li Lu has a legendary status in the value investing community. He is famously the only outside manager that the late Charlie Munger ever trusted to invest his personal family wealth. Munger even referred to him as the Chinese Warren Buffett. Himalaya Capital is a private partnership, so they do not publicly publish their audited returns. But according to online sources and my research with Gemini, since his fund's inception in 1997, Li Lu is estimated to have compounded capital at an outstanding 20% annual rate. His philosophy is heavily influenced by Graham, Buffett and Munger. He focuses on long-term compounders, extreme patience and keeping a very high bar for what enters his portfolio. On LVI, his US portfolio value stands at $3.7 billion. Let's look at his portfolio structure. He holds only 8 US stocks. His top 5 concentration is an incredible 94.76%. His LVI portfolio score is solid 3.64 out of 5, which rates as good. Now let us check his key insights tab. Look at his business quality score. It is very good at 4.44 out of 5. That is one of the highest quality scores you will see for any super investor portfolio on LVI. And his Moats score is also a very good, that is 4.08 out of 5. Now let us look at his quarter 2 holdings and some very interesting moves. Li Lu had an activity rate of 15.52% this quarter with 2 ads and 6 holdings held flat. First, look at his top 2 holdings. Alphabet Class A and Class C combined, Alphabet represents nearly 48% of his entire US portfolio. He held both flat this quarter. Let's open the transaction history model for Alphabet, ticker GOOG, to see his journey with this particular stock. You can see he first bought Alphabet back in quarter 2 of 2020, that is around COVID. But his most interesting move was in quarter 2 and quarter 3 of 2022. When Alphabet stock crashed and was trading around $100, Li Lu didn't panic. Instead, he backed up the truck, adding 77% more shares in Q2 and a massive 1900% more shares in Q3. That is the signature move of a Munger style investor. When a high quality company you understand goes on fire sale, you buy aggressively. And since then, he has held it steady, letting the business compound over time. And now let us look at the big moves of Q2, because Li Lu basically cleaned house this quarter to concentrate his capital. First, let's talk about his starter positions. In the first quarter of 2026, Li Lu initiated new starter positions in S&P Global, Moody's, MSCI and H&R Block. But just 1 quarter later, in quarter 2, he sold 100% of all of them. These were likely trial positions where he was building conviction, but he ultimately decided to scrap them and redirect that cash into his highest conviction holdings. Second, look at Occidental Petroleum, ticker OXY. Li Lu first bought Oxy in Q2 of 2024, making it 3.61% of his portfolio. But this quarter, he completely sold out of his entire 1.4 million share position. Third, he also completely liquidated his position in Bank of America, BAC, selling all 2.9 million shares after trimming it heavily by 71% last quarter. Probably this was expected. So where did all this liquidated cash from Oxy and Bank of America and his starter positions actually go? It went straight into his high conviction anchors. First, he added heavily to Pinduoduo holdings. He increased his shares by a massive 133%. Pinduoduo is now his third largest position at over 22% of his portfolio. Second, he increased his position in Berkshire Hathaway Class B shares by over 23%. And Berkshire now makes up 15% of his portfolio. Think about this setup. Between Alphabet, Pinduoduo and Berkshire, three stocks account for over 85% of his entire US holdings now. This is the definition of concentrated conviction. When Li Lu finds a business he understands, he bets big. Now let us look at our third super investor. And this is Mark Massey, the founder and chief investment officer of AltaRock Partners. According to online sources and my research with Gemini, from 2015 through late 2023, his fund compounded capital at an estimated 15.3% annual rate, comfortably beating the S&P 500's 12% return over the same period. What makes Massey unique is his investment filter. He famously rejects quantitative stock screening. He does not use software to screen for cheap stocks. The only exception is screening for companies that are aggressively buying back their own shares, which he views as the ultimate signal of management's conviction and a strong economic moat. Additionally, Massey is disciplined. He only purchases stock if he expects a 15% gross annual return over a 10-year holding period. On LVI, his US portfolio value stands at a massive $4.24 billion. Let's check his portfolio now. He holds only 8 stocks and his top 5 concentration is an incredibly high 96.29%. His LVI portfolio score is 3.61 out of 5, which rates as good. But the most striking aspect of this quarter is his activity rate, which jumped to 27%. Massey executed a major capital rotation, trimming his high-flying winners to buy other core anchors. First, he reduced his top holding Amazon by above 24%, bringing it to 32% of his US portfolio. Now let us open the transaction history model for Amazon to see this trim in perspective. If you look at the chart on screen, you can see he built this massive Amazon position starting in Q1 of 2022 and then aggressively buying during the crash. He added heavily throughout 2022 and 2023. So this 24.29% trim in Q2 of 2026 isn't because he lost faith in Amazon. It may be a strategic move to lock in gains after a massive run-up. Second, he aggressively cut his position in Moody's, ticker MCO, reducing it by a massive 64.89%, dropping it to just 3.23% of his holdings. So where did all this cash from Amazon and Moody's actually go? He rotated it straight into 3 premium quality compounders. He added 25% to Microsoft, ticker MSFT, bringing it to 20.5% of his portfolio. Then he added 46% to Mastercard, bringing it to 9.26%, and he added 67% to Visa, bringing it to 6.77%. This shows the core of Massey's philosophy. Find a business with a durable moat, analyze it qualitatively, and actively move your capital to where the best relative risk-reward ratio is. So those are the Q2 filings for the top 3 super investors on Let's Value Invest. We saw 3 very different and fascinating stories this quarter. First, Dev Kantesaria systematically trimming his winners, not because he lost conviction, but likely to meet fund redemptions. Second, Lilu cleaning house, exiting his starter positions and Oxy to double down on Berkshire and Pinduoduo. And third, Mark Massey executing a textbook capital rotation, taking profits from Amazon and Moody's to buy the dip in Microsoft, Visa, and Mastercard. Even when the market gets volatile, these top managers are not panic selling. They are holding, rotating, and doubling down on quality compounders. If you want to track these 49 super investors yourself, check out the super investors feature on letsvalueinvest.com. It is a clean, ad-free way to find quality stock ideas and track what the best in the business are doing. So, which of these 3 managers do you align with the most? Let me know in the comments below. And don't forget to like this video, subscribe to the channel, and I will see you in the next one. Happy investing.